Today, I will be discussing risk and return on a portfolio consisting of various securities such as TECO, an energy company, Gold Hill, a domestic gold mining company, the S&P 500, and a T-bond. Is the T-bond return independent of the state of the economy? Usually, all government securities are backed up, meaning that the government gives its promise to an investor that they will return the amount invested plus interest at maturity, regardless of the state of the economy. This is because the government has the ability to print more money if necessary to pay back the investment. More importantly, the Treasury will redeem the bonds at par no matter what. Is the return on one-year T-bond risk-free? It's usually risk-free because it has such a short holding period and is not really affected by dramatic increases or decreases in interest rates or inflation. On the other hand, a 10-year T-bond will be very risky because any increase or decreases in interest rates or inflation can affect the value of the investment. Both the 1-year and the 10-year are risk-free in the sense that government won't default. As you can see on the graph, government securities are very conservative in regards to risk level. The expected return is calculated as the weighted average of the investment's possible return. I use TECO as an example to show how to calculate the expected return. We could see that TECO's expected return is 13.5%. The bottom table shows the rest of the investment returns, and based on the results, we can conclude that the S&P 500 fund has a greater return. The standard deviation is calculated as the square root of the variance. It measures the amount that a security deviates from the mean, in this case, the expected return. A volatile stock will usually have a high standard deviation. Again, I use TECO to demonstrate how to calculate the standard deviation. TECO received an 11.7%, the T-bond a 0%, Gold Hill 9.1%, and the S&P 500 a 16.4%. The T-bond has a 0% standard deviation because it's likely to obtain the expected return. On the other hand, the S&P has a high standard deviation because there is a possibility of a lower return when interest rates and inflation fluctuate. The coefficient of variation measures the amount of risk an investor is taking compared to the return they expect to receive. It's a better measure because it takes into account both risk and return. The lower the ratio, the better the exchange will be between risk and the return. TECO shows that it is a better investment compared to Gold Hill because it has a lower coefficient of variation and a higher return of 13.5% compared to Gold Hill 8.8%. If we suppose an investor forms a stock portfolio by investing $10,000 in Gold Hill and $10,000 in TECO, we could see that the expected return is 2.23%. The standard deviation is approximately 1%, and the coefficient of variation is 0.26. These values are much lower compared to the individual stocks because the risk is spread between the two investments, and this is highly due to the fact that these two stocks are negatively correlated. When one increases, the other will decrease. This time, the investor forms a stock portfolio by investing $10,000 in TECO and $10,000 in the S&P 500 fund. These two stocks are positively correlated and therefore won't be diversifying the risk. That's why the standard deviation is at 3% and has a higher return of 2.8%. If an investor starts with a portfolio of one randomly selected stock, then adds more and more, at the beginning the portfolio will be more risky, but as stocks are added on, the risk decreases because of diversification. Therefore, if the portfolio's beta changes, it could mean either a decrease or an increase in risk. Usually, the riskier a portfolio, the higher the cost of capital. Overall, total risk is calculated by adding the market risk plus the diversifiable risk, which is the risk each individual stock carries. The lines graphed here are called linear regression lines. They tell us the relationship between two different things. For example, the graph on the bottom right shows the line on TECO. The slope coefficient is 0.105, and it simply says that for every increase in x, y increases by about 0.105%. The security market line graphs the returns calculated by the CAPM. It tells an investor the minimum amount of return they should expect at any given risk level. TECO had a return of 12.2% based on CAPM, but has an expected return of 13.5%. This tells us that the stock falls above the line and is undervalued and would be a good stock to invest in. TECO's return based on CAPM is 12.2%. But if inflation increases 3 percentage points above the 8% risk-free rate, the required return would increase to 15.2%. If market risk premium increases from 7% to 8%, the required return would only slightly increase to 12.8%. If beta rose from 0.6 to 1, the required rate of return would increase to 15%, matching the market return. This is because a beta of 1 is considered the risk for the market. Efficient markets of hypothesis, a theory that simply says that there is no use in trying to beat the market because the markets are efficient and therefore the stocks will always sell at their fair values. This would suggest then that investors will only be able to purchase stocks based on beta, the riskiness. We could also assume that this isn't applicable to real assets such as plant and equipment because their value depreciates over time. Here we will assume that TECO's long-term debt ratio decreases and will keep decreasing. In theory, the lower the debt ratio, the better, because it means they have more assets than debt. So this will have a lower risk, lower beta, and they would also have a lower required rate of return on equity. Although, if it's too low, this could signify the lack of good credit, which means they probably can't obtain long-term debt. So this would increase their risk, increase their beta, and have a higher required rate of return on equity. Overall, TECO would be good to invest in, but it would also be a good idea to include the other securities in the portfolio like the bond, the gold hill, and the S&P to diversify risk and to achieve the highest possible return. Thank you for watching.